I'm John Hanna for CDTV.net in New York, and we have Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk, how you doing?
Oh, not too bad, John. How about yourself?
Great. You know, it's a beautiful day here in New York City. How about your location there?
No, it's sunny and clear, but a little bit on the chilly side. But then again, it is November.
Yeah. All right, let's talk about GDP. What do you have for us?
Well, in the third quarter, the first look at the data, GDP grew at an annual rate of 2.0%. That's a slight acceleration from the 1.7% we had in the second quarter, and it was a little bit better than I expected, although the sources of the growth were a little bit suspect. And the best way to look at that, rather than looking at the percentage change in each of the major components, is how much they actually contributed to growth, because the different parts of the economy are wildly different sizes. The biggest contributor to growth by far was the consumer, personal consumption expenditures, the C in the C plus I plus G plus net exports part. That contributed 1.79 of those 200 growth points. And within there, and that was up pretty nicely from 1.54% in the second quarter and 1.33% in the first quarter. So that's on a nice upward trend, and that's pretty high quality growth in the PCE. Although one of the long-term problems we have is really that consumption is much too big a share of the economy. But at least in the short term, it means that consumers have got a little bit more confidence. They're out there spending, and that's pretty good. And if you look at where it's coming from, the big increase was in the amount we spent on services. That was 1.15 points of growth. So more than half of what of the total growth came from consumer spending on services. That's up from just 75 growth points in the second quarter and virtually nothing, 0.3 points of growth in the first quarter. Spending on durable goods was down a little bit in terms of its contribution in the third quarter at 44 growth points, down from 49 in the second quarter and 62 in the first quarter. As was spending on non-durable goods. And non-durable goods is a lot bigger than spending on durable goods, the economy, but it tends to be more stable, and it only added 20 growth points, down from 31 in the second quarter and 67 in the first quarter. We also got a very nice positive contribution from gross domestic private investment at 1.54 growth points, but that is down sharply from the 2.88 points in the second quarter and 3.04 in the first quarter. And we'd really like to see as much of a contribution as possible from investment, and unfortunately, the bulk of what we got was not from what you generally think of as investment, being companies investing in new plant and equipment or building office buildings or anything like that. It was an investment in inventories. And this is the fifth quarter in a row that inventory builds have been contributing positively to growth. And that was 1.44 growth points. So almost all of the contribution from investments came from growing inventories. That's up from 0.82 in the second quarter, but down from 2.64 in the first quarter. So that's a very low quality form of growth. Investments in equipment and software, which is sort of And what we'd really like to see was a positive contributor, adding 80 growth points, but that was down from 152 in the second quarter and 124 in the first quarter. Investment in non-residential structures was virtually non-existent again. It added just 10 growth points, 0.1%. That's up slightly from a decline of 1 growth point in the second quarter and a decline of 53 growth points in the first quarter. But then again, we've got an awful lot of empty office buildings and strip malls, so it really doesn't make a lot of sense for companies to be spending a lot of money putting up new buildings. Residential investment, home building and home improvement, again was a major drag on the economy, subtracting 80 growth points. That's a huge swing from the second quarter, where it actually added 55 growth points. But out of the last 16 quarters, 14 of which we've seen home building or residential investment be a drag on growth. The real big drag on growth, though, continues to be net exports, and it's really our increasing imports the problem. We're actually growing exports kind of nicely, but it doesn't make up for the increase in imports. Net exports subtracted 201 growth points. In other words, if the trade deficit had managed to stay just exactly the same size as it was in the second quarter, in the third quarter, the economy would have been growing at 4% instead of 2%. And actually, it was a somewhat better performance than we saw in the second quarter, where net exports were just disastrous and subtracted 350 growth points. In other words, we would have been growing over 5% if we had managed to keep the trade deficit where it was in the first quarter. Exports added 61 basis points, but we got a subtraction of from growing imports of 2.62 growth points. That's just a massive drag, although that's down from 4.58 growth points in the second quarter. And then, government was a positive contributor, and all of that coming from the federal government side, adding 0.68% or 68 growth points. That's down from 80 growth points in the second quarter, but up from a drag of 32 growth points in the first quarter, with the federal government chipping in 71 growth points, but state and local governments being a 3 basis point drag on growth. I was actually a little bit surprised by that. I thought that we'd have a much bigger drag from the state and local side, as the states are being forced to cut spending due to lower tax revenues and the inability to run deficits. Overall, the report came in a little bit stronger than I was expecting, but a lot more of that growth came from inventory growth than I was expecting. So net, let's call it a wash relative to the expectations. Certainly not a very robust report. I mean, nobody's going to confuse this with a boom. We're sort of caught in this limbo where, the economy is growing and back on track, although it's still growing, less than its potential, which is closer to 3% growth, and we still have an awful lot of ground to make up. And 2% growth is not going to put a very big dent into the unemployment. It may be enough to just sort of stabilize it where we don't see further increases in unemployment, but it's not going to bring it down anytime soon. And so it's hard to really characterize this as either a great report or a seriously disconcerting report. It's just sort of we're kind of chugging along in limbo. Looking forward to the fourth quarter, I suspect that the consumer will still be a fairly decent contributor to growth, maybe a little bit less than that 1.79, but we're still going to have the drag from residential investment. I think we'll have some more drag from the state and local government side, and probably less contribution from the federal government, although that's probably more of a 2012 or 2011 story than a fourth quarter of 2010 story. As we're not going to get any additional stimulus if the Republicans have control of the House of Representatives. We'll just be in a gridlock situation, and I think that's going to cause a lot of uncertainty, and that uncertainty may result in businesses being less inclined to step up in investment. So I don't see the economy really taking off in the fourth quarter, but we're probably looking at another one of these sort of 2% or a little bit short of 2% growth in the fourth quarter. Again, not falling back into recession, but not growing fast enough to make it feel like we're not still in a recession. Is kind of my the big wild card is whether we'll be able to make any dent in the net export situation. If we can start turning that around and increasing our exports and cutting back on our imports, then growth can be a lot stronger. I mean, certainly if one just looks at the domestic side of the economy, it's actually pretty healthy, but we're facing this massive drag from the trade deficit, and that's plus the drag from housing, and there's no real reason to expect that much of a change on the housing front. We still have at least 1.5 million excess housing units available, and until that is absorbed, it's hard to see why home building would really start to pick up. Now, when home building does start to pick up, and we're talking that being a 2012 story, then we're going to start seeing some really, really good economic growth. But that doesn't seem right on the horizon. That's we still have this overhang to work through.
That's Dirk Van Dijk, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York City.